Hey, good morning or good afternoon, everybody. We'll go ahead and get started. Today is the 10th, and we started last week talking a bit about risk management and insurance, and we're going to pick up some of that today and complete that. One thing I should know, and you should be aware of, is the fact that I replaced the PowerPoint slides from chapter 13 or for week 13, and so some of this content goes back to week 13. So I replaced those. So make sure you go in there and make that change. There were some slides I had forgotten. I was looking over early this morning, and I noticed that there were some slides I intended to put in there with regard to insurance that didn't make it in there. Actually, I think it was risk management and insurance. And so I wasn't sure if we'd get to this point in class, but fortunately we did. And so make sure that you have got those in there and that you're looking at those. So I'm going to pick up on, and they're posted now, so they should be. Actually, no, they're not posted yet. They will be. Take that back. They're posted. I was going to update the Brightspace course. I haven't had a chance to do that yet. Just sort of fiddling around with some of these slides here, trying to insert those. So I'll replace that and fix that. So if you look on the whiteboard here, I've got the schedule of what we're doing the rest of the semester, since we're in next to last week, if you can believe it. So we're going to cover the rest of chapter 16 today, which deals with risk, insurance, and what it's all about. And we talked a bit about risk and risk-taking, risk-seeking, etc. And we're going to sort of finish that up. We're going to talk about this activity called risk management, which is really a central business. Is more important than ever, and it's almost on a par with some of the other functional areas within businesses like finance and operations and whatnot. It sort of is along the same lines oftentimes in organizational structures as, say, personnel, and IT, and those kind of things. Particularly for bigger businesses, you probably wouldn't see it as much with smaller firms, but you definitely would with bigger businesses. So we'll take a bit of a look at that. Then we'll get into international trade, and there's a very big discussion about absolute and comparative advantage. I'm going to kind of give you the quick and easy version of that, because I think that this is really a topic, that is the issue of comparative and absolute advantage. Fits better into like a macro section, but I'm going to focus mostly on what it means to us in terms of what we're doing here in micro. And so chapter 19 will be the last. On Wednesday, we come back, I'll talk about the fourth exam, which will be available this week. And so you'll take that, it'll be due on Sunday, and I'll give you all the details, the rundown on that on Wednesday. We come back next week, assuming everyone's taken the first three exams. Now, I know that there's a video that I have not yet posted. I realize that. We've got sort of an unusual situation. We have a student who sort of has been transferred in from another section with a very unusual situation. And so I'm sort of making an accommodation, and that person's yet to take the third exam. And so I was asked by administrators to make some accommodation on that. So unfortunately, because I've gone over that third exam, actually, I don't think we have to go over it all, because we already talked about it, didn't we? So I guess we talked about it in class, but I'll say 4 if everyone's taken the fourth exam, and that may not be possible. I don't know. I mean, it's rare, I think, in my experience, that everyone takes the exam on the week that's due, even though I know it sounds like that's kind of crazy, but that's in fact what my experience is. So next Monday, we'll talk about the first 2 exams. I know there was some appetite in the course in this section about going over old exams and getting the answers. And as I explained to the class a couple of class sections ago, that this is an area that I think we've sort of treated the Attend Anywhere sections as more or less like the online courses. We just sort of make the exams available. If you have specific questions, you'll ask about those. But for the most part, I have no trouble going over the exams. I think it's a great idea, and so we'll do that. Then on Wednesday of next week, bring all your questions. Well, actually, bring all your questions on either class session, Monday or Wednesday, either one, and I'll go over them. I'll answer any questions you've got. Any kind of gaps in your understanding, then that's fine. We all have gaps from time to time. Let me know, and then I will do my best to answer your questions. Okay, so. Any questions for me with regard to that? Okay, and anybody on the Zoom call could feel free to ask as well. I'm going to try to do my best today. I broke a tooth over the weekend. I was telling the people in the class here earlier, and so it's kind of stabbing my tongue. And so it's healed a little bit because didn't do much talking yesterday. So we just kind of relaxed on Easter Sunday, but I'll do my best to make it through the class, and hopefully everything will work out okay. All right. So where did we end up last time? We were talking about risk in general, and let me kind of back up just a little bit here. We talked a bit about this idea of risk aversion and risk seeking versus risk aversion. We said that risk aversion is probably the norm for most people. We said that there are people out there who are risk seekers, and we tend to think of them as being sort of the true entrepreneurs that sort of come to mind and are sort of household names like Henry Ford, Bill Gates, Steve Jobs, etc. But one thing I should mention is the fact that this entrepreneurial idea, this idea of risk taking, is sort of now being promoted within companies. And that is the idea of how do we do things a little bit differently? How do we take risks? Because one of the things that I think is that we have discovered in studying businesses over a very long period of time now is the idea that those who are fantastically successful take great risks. Now, obviously, with risk comes the possibility of great loss, and so as a result, you've got to balance the risks, and that's really what the whole idea of risk management is sort of balancing risks. But remember, we talked about this idea of risk tolerance. We said that there are risk seekers and there are risk averters, and it can apply not just to individuals but also to business firms as well. And when we talk about risk seeking, even though this is probably a minority of people, and I think probably even a minority of business firms, actually, the idea that which associates risk with gain. Now, remember what the definition of risk is. Risk is not loss. Risk is not danger necessarily. Risk is simply defined in economics and finance as the degree of uncertainty of an outcome. If something is uncertain, we say it's very risky, even though it could be something good. If I buy a lottery ticket and expect to win $1 million, it's a pretty risky proposition, but I could actually win $1 million. And so that's a good payoff, obviously, but obviously I could lose it all, which is probably what's going to happen, buying a lottery ticket. But risk seekers are those who seek out risk because they associate it with gain. Those who are risk averters associate risk with loss, and that is the uncertainty of outcomes. I don't want to do this because, hey, what if this happens? What if that happens? These are bad things. These have got to be mitigated. I don't want bad things to happen, which is human nature, right? I don't want bad things to happen. And I know that we've sort of presented this from the standpoint of individuals. And I think that the issue here is taking this idea of individual version of risk-seeking sort of attitudes and applying it to organizations generally. And I'm talking here about the private sector, frankly, and how do companies take risks and why would they do it? And given the fact that risk can't be taken down to zero. In fact, we say most people are risk averters. And that is, and it's thought to have a biological basis. And I know that there's lots of literature out there. In fact, I think I mentioned in class last week that there's a sort of subfield within economics in general called behavioral economics. And when I actually subscribe to a couple of the sites that have current publications in behavioral economics, I find it to be pretty fascinating. So why people do what they do. And there's a physiological basis, there's a psychological basis, and in the case of risk, psychological basis, and obviously as economists, we're probably not as well suited to describing what those biological bases are, other than the fact that most economists believe there's some basis by which we are cautious by nature, and that it's sort of ingrained in our beings, and we're sort of cautious from the very beginning. We don't know who to trust. We don't know what to do. And so as a result, we develop routines and we do things because routines make us safe. That is free from risk and all the bad things that can happen, even though risk can also result in good things. We also talked about the idea that risk aversion becomes sort of the norm over time, mostly as a function of age. And by the way, that's also a function within businesses themselves, where businesses, as they are more mature, they've been around for a long time, they have sort of a collective memory of bad things that can happen or outcomes that are uncertain and maybe are undesirable. And I can tell you that when I started in the business world, some time ago, around out of college, I worked for a company that had been around for a very long time, since the 1850s, and had lots of experience with outcomes they didn't want to have happen. And so they would always tell us, be careful about this, be careful about that. to the point where it became really sort of ingrained. And at first, I think I thought, like a lot of my fellow trainees, that they're just being paranoid. I mean, it's maybe one thing happened 10 years ago and it didn't happen 30 years before that and whatnot. But the longer you're around, the more you see weird things happen that are unexpected. And we go back to the very first day of class, we talk about economics being defined as the social science dealing with conditions, choices made under conditions of scarcity and uncertainty. This is where the uncertainty part comes in. I said we come back to that a bit later. Now we're coming back to it. Okay, so all these development routines, and then a better ability over time to manage the risks that remain. And that is, as we get more experience with doing something, we better manage the risks. I want to talk about risk management. I did a little bit of work prior to last week's class, and I found some really good definitions as to risk management. And I found one from Marquette University, so I'm going to decide on my source here like a good scholar. And the definition that was provided, I thought was the best that I'd seen, is risk management is the continuing process to identify, analyze, evaluate, treat loss exposures, and monitor risk control. Now, notice when we talk about risk, obviously the term risk management is part of the term itself, but we're talking about loss specifically. That is, if it's a good thing, if it's a gain, then that's fine. We're happy with whatever outcome is good. We want to prevent loss, and so as a result, what are we saying here with risk? Risk management assumes that we are risk averters, and so companies that have done, and this is, by the way, this is corporate. This is a business concept, risk management, that we're associating risk with loss. And so as a result, we're trying to mitigate losses and try to control them. And so to mitigate the adverse effect, obviously the adverse effects of loss. And so that's really the issue. And so we're saying, okay, risky things can be bad. So as a result, we want to try the effects of risky things. Now I know that and I mentioned it at the outset that this is an entire sort of subset of business activities, and sometimes within bigger companies in particular, there are entire risk management departments that do all these kinds of things. They try to identify the risks. These are the steps. Now, by the way, if you were if you look at in insurance textbooks and other sorts of textbooks, you'll find that very often you'll have all kinds of different steps in the risk management process. I sort of summarize. I try to make this as simple as possible because sometimes there are multiple steps. I don't want to get too into that. If you really are into risk management, then you'll obviously have lots of opportunity, particularly if you're a finance major, you might come across some of these. But the issue is identifying risks. And again, risks being uncertainty of outcomes. Analyze what those risks are in terms of what can happen if, right? Now, by the way, and we're going to talk about insurance in a minute. Insurance is one of those ways to mitigate and to control risk. It's been around for a very long time. And I think, as I understand it, the very earliest insurance was for shipping, that is to insure the loss, insure against the loss of cargo on ships. And so the idea was to try to analyze what can go wrong, and if it does go wrong, what do we lose? And so as a result, we can pool our risks together, those of us who have similar and shared risks, and therefore we can sort of spread the risk around because it's not something that's probably not going to happen to all of us, it's going to happen to some of us. And then control the risks. And that is, if we know that there are risks out there, maybe we don't do something. Maybe we avoid certain things, or by the way, one of the things, and if you really get into this in depth, you'll see that some organizations actually engage in what's called retention. And that is, they know that there are going to be some bad things that may happen. And so as a result, maybe they don't want to insure against it because that costs money. And I'll talk more about that in a minute. Yeah, so instead, what they'll do is they'll simply reserve for the risk itself. And I know that there are some companies, in fact, that will do things like issue bonds in the public market, issue debt, just to have a big pool of funds available so that if something happens, they at least have access to cash, and they go to the market where they don't need to borrow. That is sort of a rule of thumb in finance: borrow money when you don't need to. You're better able to get the financing you need at a lower cost. Because when you need to borrow, that, it's kind of like Murphy's Law. When you need to borrow, it's not going to be available, or it's going to be at a higher cost. So there are some firms that actually, one way to mitigate the financial issues are to simply raise a pool of funds in order to have them on hand. And obviously that sort of opens yourself up to the sort of deep-pocketed sort of issue. And I know that a lot of businesses are always paranoid about being sued, and they should be, because lawsuits are something that you really can't control. in terms of risk. We go back to the Coase theorem and talked about the fact that we should, if you're being sued, you probably should think about settling rather than the unknown, dealing with the unknowns, and also reviewing the controls. Okay, so those are all issues that revolve around this idea of how do we engage in risk management? What does it mean to engage in risk management? Okay, and I want to talk about one of those control mechanisms is insurance, and I want to differentiate between two types of insurance: private and social. Sometimes called governmental, the second category. So when we talk about private insurance, this is what most of us consider or associate with insurance. We think of going to State Farm and getting an auto insurance policy. That's one example. There are all kinds of different examples, and the examples I gave are always sort of just an introduction. There are lots and lots. Even within business insurance itself, there are all kinds of different types of insurance. You might insure somebody for a particular thing, a particular occupation. You might have what's called errors and omissions insurance. In case you were doing business with paperwork and you make an error or forget something, then there's coverage for that. So within business, there are all kinds of different categories. I know that having grown up near Indianapolis, the Indianapolis 500, oftentimes the drivers will buy an insurance policy for that day, so that if they die that day during the Indy 500, they'll have a payout of X billion dollars or whatever, that sort of thing. So there are all kinds of different types of insurance, oftentimes purchased through Lloyd's of London, which is not an insurance company, but it's an insurance exchange, which has been around for about 300 or 400 years and simply handles insurance. And it's just a collection of underwriters who agree to take on risk and to insure against those risks. And so when we talk about private insurance, here are some differentiable factors between private and public insurance or social insurance. Number one, insurers select their customers. Now, I mentioned this on Wednesday last week. I said this is one of the few businesses where they pick and choose who they want to do business with. And this is not that uncommon. I know in finance, like banks will decide who they want to lend money to and who they don't. Obviously, they can't violate certain laws with regard to, being discriminatory in terms of things like race, ethnicity, and whatnot. But they certainly can in terms of age, and they do. And they select or not select. I mean, you can't really buy life insurance if you're in your 80s. I don't think. I mean, maybe you can, but it's only going to be for a limited time. By the way, I know that we're inundated with these ads on TV with Colonial Penn, where they say, okay, if you're 50 to 85, you can buy this insurance. What they don't tell you, it's in fine print, because I kept seeing these ads. I kept getting things in the mail once I turned 50. It doesn't cover you for the first 2 years. If you drop dead in the first 2 years, there's no payoff. And the cost is it's $9.99. I think pays for like $1,000 worth of insurance. It's not that much. And so as a result, yeah, they'll take you on if you're 78 years old or whatever, but it's going to cost a lot. So in other words, they're selecting you. They're also placing you in a pool to which the price is assigned. And obviously, we wouldn't expect life insurance companies to price people who are in their 70s, the same as people in their 20s. I think we can expect that. But the key thing I wanted to point out is the fact that they select their customers. And at one time, they were, very exclusive in terms of, and they were very discriminatory. And in fact, they discriminated on the basis of race, and they discriminated on the basis of gender, and all that. In fact, a lot of people in the financial world engage in lots of discrimination, which no longer exists. The process of what's called redlining used to be a real thing, whereas they would sort of delineate parts of the market they didn't want to do business with for various reasons, maybe income or whatever. Today, those are mostly falling by the wayside. But insurance, I should mention, is one of those industries it's still regulated primarily at the state level, and so as a result, they can do things. They can do things a lot of companies that you would not think that a lot of companies elsewhere could do. You can't walk into Smith's and they say, I don't want to sell you these, this milk today. I just don't want to do it. It just doesn't happen. There's just not that sort of discriminatory nature, or you're too old to buy toys or whatever. I mean, obviously it's an absurd example, but insurance companies are one entity that can do that, and the prices are called premiums, and so that's a little bit different there. We should also make clear that insurers are for profit, and that's an interesting and important thing. By the way, there was an effort around 20 years ago for these mutual, I think I mentioned this last week, that some of these mutual companies, particularly life insurance companies, were sort of spinning off their operations to become for profit as opposed to mutual. Mutual companies are sort of theoretically owned by their customers. And there are still some mutual insurance companies. I believe State Farm is. I don't know about Allstate, but a lot of the life insurance companies were simply saying we're going to be regular for-profit stock companies, and we're going to be where our stock is going to trade on the New York Stock Exchange or wherever. And so as a result, they are for-profit. And so this is one explanation for why insurance companies do what they do. And a lot of times we think they're being very unfair, and maybe they are, maybe they're not, but trying to maximize profit. Again, we go back to this idea that economic actors are seeking to engage in maximizing behavior. And so some of the things they do is they engage in selectivity, they reprice risk and whatnot. If you've had tickets, if you've had vehicular arrests, your premiums, your costs will go up. If you're talking about auto insurance, sometimes they'll drop you altogether. I can't think of too many other businesses which will simply say, okay, we were doing business with you for 10 years, now we're no longer. Sorry, see you later, goodbye. I mean, it really is an unusual situation, but because they're assuming risk, it's understandable as to why they would do it. Now, the final thing I want to mention here on private insurance is that insurance itself is a subset of the whole issue of risk management. It's not the other way around. And sometimes I think the idea is that somehow insurance is a process. It's just a thing that everybody has to engage in. So risk management is one of these add-ons, these sort of tools by which we sort of lower our cost of insurance, and therefore risk management is sort of a subset of that particular financial activity. And it's actually the other way around. Insurance is actually a subset of this. Risk management is a way to do things that try to avoid loss in the first place. Because insurance companies are insuring against perils which can create loss. That is any kind of a danger, that can happen. Maybe an unsafe product. I know that when I worked at a place when I was in high school, we would frame artwork, and we had really sharp edges sometimes on these metal frames, and they would be on us constantly. Somebody's going to get cut, somebody's going to get hurt, we're going to be liable, all that. So we have to be really careful about sharp edges and whatnot. That's a peril. That's a peril that can create loss. And so as a result of that, even though it was a small business, we were still involved in our own way in terms of risk management by trying to reduce the potential for loss, engaging in all those activities, identifying the loss, analyzing its impact, and trying to control it, and then analyzing those controls to make sure those controls are effective. Okay, so risk management is really the sort of overarching umbrella topic that tries to deal with that. Okay, and then finally here we talk about social insurance. So social insurance, sometimes called governmental insurance, is different in the sense that it is issued by government. Insurers are a little bit less selective of insureds, and that they're not placed into risk pools. Instead, they're separated by qualification status. Often it's by age and or by disability or something of that nature, or by whatever the status is: age, disability, employed, unemployed. And there's no profit motive necessarily. There's a social welfare sort of motive that's involved. And I probably have missed some social insurance programs, particularly in some state levels. Some states, California in particular, has a health insurance program of their own. I believe so does Massachusetts. But those are examples of social insurance dealing with healthcare. Federal level, we don't have that, except for Medicare, which is a form. I guess that's one glaring omission here that I didn't put here. I guess is a form of social insurance. You don't have to do anything to receive it. You just have to be eligible. So it's qualification status. And I realize when I say you don't have to do anything to get it, you just have to be eligible. It sounds like it's a little bit of a harsh assessment, because you have to have worked and paid in order to get Social Security. And Medicare is a little bit different. It's a little bit different. It's more of an age issue. Social Security, you just have to be eligible for it. There's a retirement benefit. There's also disability within Social Security. I realize too, there's a hospitalization part of this as well. So we could do an entire semester on Social Security. Let's not do that. But when we talk about Social Security, you simply have to be eligible in it. And even with a disability, there are different types of disability: SSI and SSDI that exist in those social programs. Again, there's no profit motive. And I know there's been a lot of talk in recent years about what to do about Social Security and whatnot. And, with all these dire warnings about, hey, is Social Security going to be around? Is it going to disappear, et cetera? But I can tell you these warnings have been around for a very long time. And I really, really doubt that Social Security is going to go away. I know my father-in-law was saying when he was a kid, he kept hearing, or was younger, he kept hearing about Social Security is going to go away, it's going to go away. And I really don't think it is, because it's such an integral part of people's expectations about what we want from government. And I really doubt that there's going to be a lot of tinkering. What they have done is push back the age of quote unquote full retirement benefits. But that in itself is a little bit misleading, because what does it mean to have full retirement benefits? Because at 65 is now going to 67, but you can wait till 70 and give even bigger benefits. So if that 67 is full, then what is 70? These terms are a little bit misleading, and you can get it as early as 62 if it's a normal retirement situation. And I realize too that there's a death benefit and whatnot within this, but all I'm simply saying is these are not intended to be for-profit products, but they are simply there to provide social welfare. Unemployment, which is a federal program, and it's funded by what's called the FUTA tax, federal unemployment tax, on businesses primarily, and it's administered by the states. A lot of federal programs are actually administered by the states. Unemployment is one of those. Workers' comp tends to be more of a state issue. We do have a workers' comp program here. Not all states do that. There are veterans benefits and the entire array of those. And so those are all social insurance. Those are all to protect people who have a need, and government is there to provide that particular need. Because remember, one of the things in dealing with market failure is the idea that the private sector can't provide that. So, and Social Security was created in the middle of the Great Depression because of the fact that so many people had lost savings, and so as a result, their retirement savings was gone because of bank failures, and you name it, the entire economy just became unwound during the Great Depression. And so Social Security was really created to try to deal with that particular problem of what to do as people got older. Okay. All right, so any questions about social insurance? I've got one more topic that's not in your book with regard to chapter 16, but I think it's important too, because remember, this will sort of overall conversation about market failure, which we began really back in chapter 12. We talked about externalities, that is those spillovers, and we sort of carried it in here to things like risk management and also things like public goods and free riders and common goods and all that. And it's the idea of how do we view regulation. And I want to talk about regulation from the standpoint that regulation may not be what we expect it always to be. And I think the average person may think about regulation as being, particularly if they're not a very cynical person, as being, okay, government is there to protect us from bad things which can happen, particularly since there's no incentive for private actors to behave like honest citizens, and so as a result, we have regulation to control the way products are produced, and which we call industrial regulation, the way we produce those goods from the input side, and it's what we call social regulation that deals mostly with labor issues. But then again, there's perhaps a distorting of that, and it really depends upon your point of view. And I think there's some evidence for this latter. So this first and more optimistic view is one theory of regulation. It's called the public interest theory. This is I think the intent of regulation to begin with. And I think a lot of regulation may well serve this particular, or may well fall into this particular categorization. It's the idea that regulation is designed by the government to protect the public at large from the possible abuses that it might receive, particularly from producers. And this is important that we talk about this industrial regulatory issue. And that is business, as we've seen, in the case of pollution, in the case of unsafe products, have really very little incentive to create safer products or to avoid things like pollution and spillover effects of various kinds. So as a result, government steps in to fill that particular void because there's a cost imposed on society from some of these issues. And so as a result, government steps in to sort of make that, and they deal with it in things like taxes and regulation and whatnot. Because the assumption here, these are the assumptions, in the absence of such regulation, the abuse is likely. And the evidence for that is the fact that sometimes when regulators are sort of taking their eye off the ball, as they sometimes do, bad things can happen. And I think of the financial industry. Think about all the deregulation, which went on for many decades prior to the financial crisis of 2008. Frankly, the banking industry, and I was a part of this, and for a long time, as I've noted before, was finding hard, to get Congress to remove some of the regulation that was imposed on finance in general, some of which was outdated and which needed to be replaced because it was just woefully outdated. It didn't even make any sense. Like there was a regulation at one time that regulated the interest rate banks could pay on savings accounts. Well, nobody even really could tell you the reason why there's a regulation as to the limitation they can pay on savings accounts. It didn't make any sense at all. It was way outdated. And it was basically hamstringing banks because people were closing their savings account to go get higher yields elsewhere because they weren't getting the kind of returns that they expected to get, simply because banks were hamstrung. So some of this needed to have been taken down. But I think the evidence is clear that because there's deregulation, regulators simply weren't looking, and this whole subprime crisis got underway. The origination of subprime loans, and don't take my word for it. Alan Greenspan, the former chairman of the Federal Reserve, in his autobiography said, "Yeah, the financial crisis, we probably should have seen it coming. We should have dealt with it better. We should not allow these subprime loans where somebody walks into a mortgage company with no money down to buy a house, and also says they can make up the income, whatever the income is, and so somebody, a school bus driver, makes $120,000 a year, which probably doesn't make sense, but as long as their credit is reasonably good and the credit score fits the criteria, let's make a loan." Well, that defies some of the logic in general. First of all, the income is probably phony baloney, and by the way, I saw my share of these so-called liars loans when I was in banking. Right? This was one of the things that was really, to me, it was very disgusting. In fact, I told my boss at one time, I said, there's a line on the application, the loan application that says, under penalties of perjury, I certify as a borrower that this information is correct. I said, we're asking people to basically commit perjury. I mean, perjury is in a court proceeding, as I understand it, but we're actually going to basically commit fraud by lying about their income. Well, that would not, if the public interest mechanism was working better. And by the way, if you think that okay, well, the subprime thing, well, banks got what they deserved and whatnot. Well, maybe they did. They probably did. But also it impacted the rest of the economy because banks were basically caving in on each other. They weren't lending each other money. Liquidity was drying up. I know that at the time they were cutting off a lot of business credit. A lot of people's credit cards were canceled. And so it has a real effect on the economy as a whole. And so as a result, if we have a strong public interest spirit behind regulation, it therefore is effective at serving the public. And so the evidence for this, I think, is best supported by that most recent example of the financial collapse that was brought on primarily by these really crazy loans that were being made. And I think anybody could have seen that would have happened. But then again, regulators did take their eye off the ball. There's absolutely no question about it. And don't take my word for it, take the word of the regulators. And there's been ample evidence to suggest that. So public interest works, though, when government does pay attention. And so as a result, we have much safer products today than we used to in the past. It's rare that you're going to get sick from eating food that you buy in the store. It doesn't mean that you're not allergic to certain foods, but it's rare that it happens. It's rare that you get on a plane and don't arrive safely. It's even becoming more rare that automobiles that you'll die in an automobile crash, which used to be much more common. And in fact, at one time, I think when I was in high school and I was going through driver's ed and all that, I think that we ended up losing more people a year in car crashes than died during the Vietnam War. That was every single year, more people died in car crashes. And so cars are a lot more safe than what they used to be. And it's mostly as a result of regulation, because firms would not have done it otherwise. The producers would not have done it. So that's one theory of regulation, is that regulation is effective and that it works and it protects the public from some of these abuses, which are likely to happen. Okay. And again, I'm not seek to the idea of market failure does not seek to single anybody out to be a broad scale criticism of capitalism in general, but rather pieces of the puzzle where it doesn't always work effectively. The private sector can't always do what's in the public interest, and so regulation is brought to bear. There's one other theory of regulation, which is here's where it's maybe not quite what you think it is. It's called the capture theory. And that is this. The regulation is sort of accepted by producers as being a cost of doing business. It's inevitable, it's going to happen. And so if it's going to happen, let's us get behind this and try to control this regulatory process. If we know that regulation is going to happen, then let us be in control of the regulation. So if we can control it, then we can choose to run the agencies which supervises. And by the way, this happens over and over and over again within regulatory bodies. A lot of times, the people who regulate the industries in terms of regulatory bodies oftentimes come from those industries themselves. And with the logic, well, who knows the rail industry better than somebody who worked in rail? Okay, but They oftentimes worked in the rail industry, go to work for the federal government, regulate the rail industry, then go back to the rail industry. Revolving door that's thought to be problematic. And this is often the case. It's often the case that Treasury secretaries are usually weighing in on that. Is usually done by people on Wall Street who decide, and very heavily influence who gets those particular jobs. And it's to regulate the banking industry primarily. And it's not only that, but it's also, I know that one of the executives at Hormel was in charge of the Food and Drug Administration at one time. And so as a result, obviously had a big share in the food industry. And so as a result, you get the idea that bureaucratic nominations oftentimes are influenced by people who are part of that industry itself. And if you can imagine, Bernie Madoff, I think at one time, Bernie Madoff, that infamous Ponzi schemer, was in line at one point, maybe run the Securities and Exchange Commission. Can you imagine? Oh my God. It's a good thing that didn't happen, but that would have been just ridiculously conflict of interest. He was running a big scam in history and a financial scam. He was going to run the regulatory body. Now, he didn't get the job, unfortunately, but it does happen. Attempting to influence legislation, new regulations, making campaign contributions. This area is like it is what you think it is. It's making contributions to politicians for their quote unquote campaigns. Now, think about this. When I was in the corporate world, we were encouraged, those of us who were officers, to make contributions to a political action committee. And it was always sold to us as you're expected to do it. We'll give you based upon your salary. This is the expected amount of your salary you're expected to give, so that our voice is heard in Washington, right? That was the term, our voice is heard. But what it really is, and we know that these campaign contributions are useful for all kinds of things, travel, hotel. So the veil was sort of looked at on part of this when Eric Cantor, who was the former majority leader in the House, was defeated in his primary campaign. And one of the reasons why he was actually challenged by an economist who actually dug into the records and found out what he was doing with those campaign contributions. A lot of it was steakhouses for multiple people and fancy hotels and golf resorts. And it was, they're pretty much free to spend that campaign money however they want to do it. So as a result, is there corruption in that? Well, you can read between the lines. And you can make that decision for yourself. But this is basically a way of influencing policy. The idea is it's influencing policy, but it's also influencing politicians themselves. So as a result, regulation is designed by industry itself to conform to its expectations. Therefore, regulation is therefore ineffective at protecting the public. So this is a much more cynical view. Sometimes it's also called the legal cartel theory. That is within a particular, we know what cartels are. Cartels are groups of cooperating producers within a certain industry. And the legal cartel theory is simply this. So it's the idea that firms get together within the industry and decide who they want to regulate the industry. And it's usually somebody who is sympathetic to that industry. And again, oftentimes that revolving door. I can tell you that at one point when I was in the corporate world too, that we had a CEO who was asked, he had this newsletter that went around and he was interviewed and was saying, look, I went to Washington, I'm pushing for tougher regulation. We want more regulation, not less. We all thought, what is he, crazy? Why would you want more regulation when there's a cost of regulation? And as it turns out, as I got a little bit higher in management, I discovered that what the purpose there was to demand more regulation, because if you were good if you're good at complying with the place, that you're going to force out of business or force lots of extra cost on those who are less able to comply. It's sort of like the cap and trade thing. It's like those who benefit are those who are better at doing something, sort of a survival of the fittest. And so as a result, the idea was we want more regulation, not less. And particularly if it's regulation that we control. So that's one thing. This is not talked about in the book. It's a little bit disappointing. It's one of the gaps I think that is not there, particularly when we sort of wrap up this whole business of market failure and that whole discussion. So are there questions about either the public interest or the capture theory or anything else for that matter? Okay, well, let's move on to, go ahead. Oh, all right. I'll be posting these if you want to. Wait a minute, that's the wrong slide. Hold on a second. I'll be posting it, so you can write them down, or I'll be available, or you can take a picture of whatever you want to do. So, okay, you okay? Okay, I will be posting. So, I do try to save paper, and I think my goal is that nobody has to actually necessarily take notes in class because it's going to be all somewhere, except with the graphs that I'll draw, et cetera, et cetera.
It's going to stick in my head more when I
Okay, well, that's probably a good idea. If you want me to go back, I will. I'll keep it up on the. I'll keep it up on the screen. I won't leave until you got that on your notes. Okay. Okay. Chapter 19 deals with international trade. So let's talk a bit about this idea of international trade, what it's about, and why it's important and why we should care about it. So when we find international trade, because up to this point, what we have done is we've talked about transactions involving. We talked about chapter 3, which was demand supply. We had, and we started out with the circular flow model where we had 3 actors: business firms, households, and government. And we sort of we just basically talked about the idea of businesses doing business with households. Then you also got households supplying labor, and so we got into a bit of the labor piece. And we involved government a bit through what government does, particularly in terms of taxing of goods and also regulation. But now we want to sort of open up this to the rest of the world here and sort of expand our existing circular flow model. So if we have households over here, again, there's no particular order by which we're ordering these. So you have firms out here. And what we've got going on here is this. Remember, the red arrows are goods flows. And so you've got exports. Those are goods going out. And imports are goods coming in, right? We know what those are, right? So there's nothing unusual there, except for the fact that now we need to account for the fact that we've got imports or export payments are money flows coming in. So we put those in green arrows there, put them in dollars or euros or whatever the case might be. And as imports come in, import payments have got to go out. And so as a result, this is what we call a leakage from the economy, where dollar flows go out. And so, but these flows, though, of exports, I want to talk about what they exports and imports both, these red arrows here. I guess I should probably leave the camera here so people watching can see this. Sorry about that. I'll swivel the camera here a bit. Oops, went too far. So, oh, hold on a minute. I'm just trying to get this camera. There we go. Okay, sorry about that. Okay, so when we talk about these red arrow flows here, we're talking about goods, and that's probably the most obvious is goods and services. Again, the term goods is sort of a euphemism, and services both. But then we've also got input factors, such as labor and capital. So it's not just outputs, it's also inputs. But inputs can flow across international boundaries, and you certainly see that happen. Labor moves across boundaries. You can take jobs in other countries, maybe temporarily or permanently. So labor has long, for many centuries, moved to where the economic opportunities are. And so the free flow of labor has been something that's been characterized human economic conduct for a very long time, long time. And in fact, there's one interesting, I think it's the very beginning of this chapter, very beginning, where there's a quote from Paul Krugman, who won the Nobel Prize in economics, and he won it primarily for his trade, his trade theory, which is a little bit unusual because it's kind of like Einstein didn't win the Nobel Prize for relativity, he won it for gravity. Well, Krugman is not really known as a trade theorist, but he won it for trade. And one of the things he talked about in trade was the fact that we sort of had this idea that sort of began in the 20th century. It's now globalization is this new thing. And in fact, globalization has been around for hundreds of years, thousands of years probably, where societies have traded with each other, goods, services, labor, even money, the financial flow. When we talk about capital here, we're talking more about financial capital. I probably should have made that clear. But the idea this has been around for a very long time. And that furthermore, Krugman goes on to talk about the benefits to trade. That is the idea of being able to trade with other partners out there and opening up the economy, globally, assist in the free flow of goods, labor, financial capital, and also things like information and technology, which I think is, we probably 30 or so years ago would not have included this last year, but also financial assets, and that is money, credit. That is the idea that we can move money back and forth. We can lend money across international boundaries. We can exchange money back and forth and whatnot. So there is this free flow of goods, and it's considered to be a good thing. So we'll talk about why trade exists in the first place. And some of these I think are may be pretty obvious, but we'll talk about what some of those are here. Okay, so let's talk about exports and imports. So this is fairly straightforward. Exports are simply defined as goods sold by a nation's producers to foreign buyers. And so we make a good here, we sell it someplace else. Our export is somebody else's import. Okay, there's what we call balance of trade, because all of the exports in the world must equal all the imports in the world globally. Just by definition, they have to be that way. But yet nations themselves can have trade imbalances, as we do. We import more goods than what we export. So as a result, we have a trade imbalance. Globally, there's got to be a balance. That is, all imports must equal the value of all exports, but they may differ. And they may differ with certain countries. We may have a surplus with Canada, for instance. As we sell more to Canada, we buy from Canada, but we might, with the rest of the world, we might buy more from everywhere else. We have a large imbalance with China. We have a large imbalance with some other countries in the world, but for the most part, it's all sort of nets out to be a deficit. But imports and exports, imports that are goods purchased by a nation's buyers from foreign producers. Okay, and then I put those green dollar flows there to sort of denote the fact that they have to match. Remember, when we talk about the circular flow model, there are very few cases in which you've got a one-way flow that doesn't have some sort of reciprocation in the other direction. One example of those are things like transfers, and that sort of applies back to our example of what we call social insurance and transfer payments, which we get into much more macro, are simply one-way movements of money in exchange for nothing. You just have to be eligible to get that. Social Security is a one-way flow of money. Medicare is a one-way flow of money. And I realize when I say you don't have to do anything to get it, it sounds like fighting words to somebody who has had to qualify, but I'm simply saying that you get that if you qualify. If you don't qualify, you don't get that. But and for the most, and those are the one-way movements. Same with unemployment benefits. You get it if you qualify, you don't get it if you don't qualify. There's no reciprocation. I mean, what you have to do to get that is you have to do some administrative things, but there's no service being rendered. Okay, and that's essentially what's going on there. Everywhere else in the circular flow model, there's a red arrow that reciprocates the green arrow, and vice versa. Okay, so exports and imports have to be met by export and import payments. Okay, so those payments then are the funds flow. So just think about one reciprocating for the other, which is essentially what we've got going on here. Export payments, goods flow out of the country, or money flows out of the country. Import payments, money flows out. I'm sorry, export payments are money flowing into the country, any compensation for goods going out or services. Import payments are money flowing out of the country in exchange for the goods that are flowing in. Okay. And so again, some of this is verging a little bit on macro. And so I deliberately chose to not really focus so much on this, because for those of you who go on to take macro, or maybe you've already had it, we get into much more detail about this, because particularly when it comes to issues concerning balance of trade generally, what does it mean? Or what does it mean to overall total output and income in the economy? These are some things that we cover more there than what we cover here. We're talking about this here as being a benefit for trade. So if we talk about what some of the reasons are, what are some of the causes for trade? They look something like this, okay? And we're going to take it from both sides of the market. We're going to take it from the demand side as well as the supply side. So why do buyers prefer to have international trade? Even though there are from time to time voices that say, hey, we should just put up a big wall and not trade with anybody. No goods come in, goods leave, no people come in, no people leave. As a result, we're like our own little island, like a big Gilligan's Island, right? Nothing comes in, nothing leaves, and whatnot. Well, there are some reasons why we probably don't want that. And one of them is simply from the demand side. There are some goods that are available that we want that have to be imported because we don't produce them. We or anybody, you can take any particular country, because I know that we tend to focus on the US here, and that's probably just, just out of habit and the fact that we all are here in the United States, so it makes sense. But think about a country like Japan that doesn't have a lot of natural resources. They don't have a lot of wood, for instance. They don't have a lot of oil. They have to pretty much import all of it. In fact, I think they don't even produce enough food to feed themselves. And so they've long been engaged in importing goods because they have to. And as a result, their people want it, need it, demand it. So as a result, if some goods are not available, you have to bring it in. And so just in our case here, there are goods that we consume, that we enjoy and prefer, that we just don't produce any of or enough of. We produce oil, and in fact, we're producing more oil than ever before. This conversation used to be really heavily skewed from an oil discussion back even 20 years ago. We talked a lot about oil as being one of the big contributors to our deficit with the rest of the world. But today we're producing lots and lots of oil. In fact, the US is the world's largest oil producer. Bigger than Saudi Arabia, bigger than Kuwait, bigger than every other country. And that's something that a lot of people probably didn't realize. But yeah, we still import oil because some of the oil we produce is also exported. So, and could we theoretically be independent on oil? Maybe within North America we could, because Canada also produces. But still, we'd rather trade because some of the oil is not in the right kind of places, and so as a result, there's trade in that. It's been old market's been going on for a very long time. Probably the biggest industry in the world. Okay, so some goods are available. So things like sugar, we don't produce enough sugar, we have to import it. Bananas, I don't think we produce bananas at all in this country, and so they have to be imported. So these are goods. And diamonds, we don't produce anywhere near enough diamonds, and so those are. So all these goods are available to us that we need to bring those in. Also, some goods are unique or desirable that we simply don't produce here. And as a result, if you want those goods, they have to be brought in to you. And so as a result, things like caviar and whatnot, we produce very much in the way of caviar. And so these are unique, desirable goods. I don't know that I've ever even come across caviar in my life, to be honest with you, but I know it's a good, I know it sells. And so as a result, it's got to be brought in as an import. And also some goods are comparatively lower price than their domestically produced counterparts. And we're going to talk about why that is the case. I know that the big thing here, oftentimes, I think our minds will go toward labor costs, and that is certainly an important topic, no question about it. And in fact, a lot of the goods that used to be made in the US are and just simply brought back because it's cheaper to do that. And the reasons why, I know that everyone wants to focus on labor, and there's certainly, it's hard to underestimate the value of the labor savings for firms that were paying workers, I don't know, pick a figure, $18 an hour here, are paying workers in China something like $1.50 a day or something, just an incredibly low amount in wage differential. And I know that it's a very controversial practice. I know the US has lost many dozens of manufacturing firms in particular to what's called outsourcing, or sometimes offshoring, whichever you prefer, simply moving operations, mostly on the basis of cost, and sometimes those goods just simply come right back. And sometimes those cost savings then mean lower prices. So I think Americans have sort of a conflicted idea on this idea of trade. And the part of the country I come from, the upper Midwest, I know that there was a time once when trade with other countries was considered to be very controversial. And in fact, I can remember working at Target when I was in college, and sometimes people would look at a garment like a sweater or a pair of shoes and find out where it was made. It was made in another country, they put it back. That's how serious they were about that. Today, I don't know that you could buy too many pairs of shoes or sweaters or jeans that aren't made somewhere else. I mean, a lot of those, we don't really make a lot of apparel here. So if that's the position you want to take, you're going to have a hard time finding domestically produced goods. And so those goods, those outputs are produced somewhere else for the most part. And it's not just the labor savings, it's also regulatory issues. And again, I know there's all kinds of controversy swirling about things like working conditions in other countries. I know for good reason there's concern because of the concerns over child labor. And we obviously don't want to support child labor. We have 8-year-old kids working in dangerous manufacturing facilities. That's not good. And nor do we want people to be underpaid for their particular labor. But it's hard to really monitor. If you're an ordinary consumer, you don't really, I mean, how do you really explore these particular issues? Even Michael Jordan himself, who sort of caught some political flack, I guess, when it was discovered that some of those shoes that had his name on it were made in very poor working conditions in China. And people were saying, hey, Michael Jordan, you should have known this. It's like, well, how would Michael Jordan know? I mean, it's not like he was there making the goods themselves. He had nothing to do with the production of it. In fact, he has nothing to do with the production of the good at all. Even if they were made in the US, his name is on the good. It's Nike that makes those goods. And Nike subcontracts the production of those goods. And if there's child labor involved, well, that's not good. But I don't think you should place the accountability where it belongs. And so and as a result, they can reduce the cost of labor and some of the and other regulatory issues as well. and those savings that are passed along to owners. And so I know that we have this conflicted view in the US of we don't want these kinds of conditions, but yet we like the low prices that we pay. And by the way, a lot of these cheap imported goods have really kept the inflation rate down for quite a long time. I know that everyone is talking a lot about inflation these days, but really inflation has been under control for many decades. It's mostly the pandemic that started this inflationary cycle, which appears to be maybe cresting. I guess we'll see. Maybe stay tuned on that. So these are all explanations for why there's trade in the first place. This is a very, very old explanation. As Krugman said, trade is not anything new, like it just started with the internet or something. It's been around for a very long time. What about from the supply side? What are some issues there? And these arrows mean one thing leads to another. And that is for suppliers, new markets mean new customers, mean more sales, which mean greater profits. The connecting of the dots here is not particularly difficult. Firms like to be able to sell elsewhere, and this is a motivation for selling to new markets and new customers and more sales. And I can tell you that when China opened up as a market, as a demand side market, not just a market for inputs in terms of labor and production, but also as an output market where firms could sell goods. I know companies were jumping all over each other, falling all over to get into that market to be able to sell their goods. And I remember I had a professor when I was in college who worked for a drug company, and he spent a lot of his time in China trying to open up markets there because China was sort of changing from the very hardcore command economy to a more free market economy, and yet they had need for things that we take for granted, like antibiotics and high blood pressure medication, that they simply didn't have. And so this company was, among many, just simply one of hundreds of companies around the world that wanted to get into that market. And China was a very large growth market then, and still is up to this point. So a very large economy. I just bring up China because it's almost impossible to talk about trade these days without talking about China. But that's one example of suppliers going where the customers are, and obviously they're engaging in maximizing behavior. What is the maximizing behavior of firms? To maximize profits. Okay. Also, some exports may be more competitive in other markets than they are domestically. That is, maybe your particular buyers are maybe your domestic buyers aren't enthusiastic about your good, but other buyers are for whatever particular reason. So as a result, some goods sell in other markets better than they do here. And this is often the case with things like entertainment products, where maybe a movie in the United States doesn't do very well, but is wildly popular in France or something like that. Just different tastes, different preferences, trying to find out where demand will be. And so sometimes the exports they find a market in order to sell their particular good. Okay. So sometimes that's that competitive issue, trying to find a market that works. Also, exporting firms may be able to make up for what is domestic shortfalls in other countries' economies. That is, and let's just go back to the case of Japan. So Japan does not produce enough food, and so as a result, other countries can do that for them. And that is to supplement the shortfall of demand of consumption versus production. So export needs to happen in this particular case. And that's why Japan has been a long time exporting country for a very, very long time. This is nothing new, even though a lot of people just thought Japan was sort of emerging after World War II as a trading economy. Not true. It's been a trading economy for a long time. They may not have been open socially to a lot of people visiting and all that until sometime in the last few decades, but for the most part, from a trade standpoint, they've been active for a long time. And then also fast-growing economies, that is, these so-called emerging markets have what we can call a nearly insatiable demand for goods. And when you think about the fast-growing economies in the world, there was an acronym that was used. It was called the BRICS, B-R-I-C-S. That stood for these fast-growing economies: Brazil, Russia, India, China, the BRIC economies. What's that?
South Africa.
South Africa, is that the S? South Africa. These are countries that were mostly emerging from, relative obscurity in terms of international trade. Russia is a little bit of a complicated situation now, given the fact that, yes, they were a command economy. They sort of had their experimentation with capitalism. It's mostly, I think, probably mostly capitalist today, with obviously a very strong authoritarian government, which is very much analogous to what China is. But Russia is a little bit of a different case. Where China has been more successful, Russia has failed for a number of different reasons. And probably the fact that international investors and businesses really aren't very enthusiastic about what they're, I think it's one place in the world where you can get locked up for doing something you would do elsewhere, and it's a difficult business environment. In fact, Russia scares me in a lot of ways. I don't have any dealings in Russia. My mom went to Russia and with some people from her church, and some people got robbed by the police. Not by the police. Money sold by the police. And somebody else did the same thing. So it's kind of a scary place. India is a great success story. India is set to become the largest population, the nation with the largest population in the world very soon, very soon, like within a year or two, I think, from what I've seen. Brazil is a little bit more complicated. Brazil was growing rapidly. They've got a big oil export business, and oil, the problem with oil is that the price goes up, goes down, up, down. I know oil is back above $80 per barrel. We saw it hovering around 70, in the mid 60s, and they're thinking it was going to go lower, but I think it's probably going to go higher. And as a result, Brazil will do better when the price of oil goes up. It does worse when the price of oil goes down. And remember, oil is one of those freaky goods that sometimes the price doesn't make any sense whatsoever, because there's so many players, and the way to understand the price is the fact that it's just all this supply and demand interaction. Keep in mind, the price of oil was actually negative about 3 years ago, about this time 3 years ago. It actually went negative for a few hours, which is obviously illogical. Okay, and then we'll talk a bit about this idea of trade restrictions, and there have been efforts to try to, oh, you know what, hold on, I gotta go back here now. And the one thing I didn't talk about, production costs, maybe I've talked about that, and the issue of comparative advantage, okay? So what is comparative advantage? Now, I know your text has got lots and lots of discussion of this. I'm going to give you sort of the much shorter version here, because I think that, number one, we talk about this a lot in macro. We do it fairly early on in the course. And so I don't want to sort of repeat things any more than what we already have to. I mean, we already pretty much go over the first 3 chapters, but comparative advantage is one of these topics that basically is about why countries do what they do in terms of specialization. Okay? Specialization. So let me just give you an example here of what's going on. And that is, comparative advantage is this idea of doing what you do best, even if it's not the best at all. So comparative advantage is contrasted with absolute advantage. So to give you an example here, let's say that we've got, again, like a lot of models that we use in economics, it's simplified, okay? It's simplified in order to sort of make a point, but you can sort of expand this to be, however many goods you want to include here. So let's take 2 countries, France and the United States, and let's take 2 outputs, wool and wine. Okay, so wool, wine, and we've got 2 countries with 2 different goods. And so as a result, let's say that however we measure wool, whether it's tons per hour or whatever, France can produce 5 tons per hour, in US 20. In terms of wine, France can produce 10, whatever the truckloads, whatever it is, realistic example, and then the US can produce 20. So, all right, so what's going on here is this. This is whatever the unit of measure, whatever the time frame is, as long as it's consistent, we've simply are making our case that this is the relative output, the comparative output between one country and the other in these 2 goods. And the explanation is why do suppliers specialize? In fact, why do entire economies specialize? And so one thing that we can know is this: when it comes to wool, the United States is more productive than France at producing wool, but is also more productive at producing wine. And so as a result, we say that in both goods, the United States has what's called an absolute advantage. An absolute advantage is the ability to use fewer resources to produce the same amount of quantity. So, in fact, absolute advantage can be thought of as being able to do something better, cheaper, and faster than somebody else. Whatever the endeavor is, and this idea of absolute advantage goes pretty much everywhere, almost any human endeavor you can think of. Whether it's if somebody can throw a baseball faster than you, then they have an absolute advantage over you, right? Okay, whatever the case is, or if you're, if you're a better card player or whatever, you have an absolute advantage over somebody else. And so in this case, the United States, for various reasons, maybe it's a more productive economy, better use of technology, maybe liberalized, things like regulation and maybe internal taxes and whatnot. Whatever the case may be, it doesn't really make any difference. But here's the case. Here's the thing, and that is this. The United States is 4 times better at producing wool than France is, but it's only twice as better at producing wine than France is. And so as a result, the United States has got a comparative advantage when it comes to wool. When it comes to wine, France has got a comparative advantage because it means that they give up less in order to focus on wine, even though they don't do it as well as anybody else. In that case, in terms of versus the United States, in this example, it's just a model. And so as a result, they should focus on wine and the United States should focus on wool. And then do what? Produce wool and then trade the excess that's not consumed. And France should produce wine and then trade the excess that's not consumed domestically. And as a result of doing that, this idea of comparative advantage, then what can happen is this. So in other words, then what happens is France's wool production goes to 0, US's wine production falls to 0. As a result, what do we have? We have some new combination of outputs where maybe the United States can now focus on producing only wool and now produces, say, 40 units, whereas before it was at 25. And now France can produce now, say, 50 units, whereas it was only 30 before. So as a result, this excess now is available, and it means there's greater amount of production globally on the particular on both goods because each country is doing what they do best. And this is important, avoiding what they do less well. And that's really the important thing. Even though in this particular example, and this is, I'm not singling out France, I'm not jumping on the anti-France bandwagon at all. I'm simply saying this is just an example where France is much less inefficient at doing wine than it is wool, so it should stay away from wool altogether and focus on wine. And then the United States is better at wine than France, but is much better comparatively, which is the term comparative advantage, than France at wool. So it should focus on wool production and simply trade the excess. And as a result, the amount of production overall will go up. And so as a result, total global trade. And this goes back really to the idea of division of labor. It goes to the idea of specialization, and that is the idea you should do what you do best. And the other flip side of that is and do what you do less well, if at all, and simply trade for that which you do less well. Okay. And the implications of this have got lots of arms and legs that simply go everywhere. And that is the idea that we don't make our own things so much anymore. If I want to go buy a TV set, I don't go build my TV set. I go buy one. Right? I don't make my own furniture. I go buy it. And whether it's internationally made or not, it doesn't make any difference. It's the idea that somebody can focus on doing something. Somebody who knows how to make furniture can do it, and I can't. And this is why households don't make very much of their own goods at all, because it's way cheaper for somebody else to specialize in doing it. Okay. Final thing, we've only got about 5 minutes, is the idea that trade restrictions can sometimes be imposed on international trade. They're done primarily to protect domestic producers. And one of the facts about these is that sometimes they end up restricting trade generally. And Krugman in that blurb in the textbook in chapter 19 talked about the idea that countries after World War I really put up a lot of trade barriers. And as a result, the Great Depression was exacerbated because of the fact that goods weren't moving globally. Everybody thought, based upon faulty understanding of economics, that if we put up trade barriers, we protect ourselves. But in fact, what we do is we simply impose speed limits, artificial speed limits, by the way, and barriers that shouldn't exist in the first place. So, but they're done to protect domestic producers. And I know that in this country, we talk a good game about free trade, although we have been as guilty as other countries imposing trade barriers. I think we actually have in Florida on imported sugar at the moment. I know back in the 80s when Japanese-based auto manufacturers were absolutely crushing it and taking lots of market share away from the big 3 automakers, Ford, GM, and Chrysler. The Reagan administration, which talked a very good game about free trade, nonetheless put a quota system on Japanese imported automobiles. It was called a voluntary quota, but it's voluntary in the sense that you're going to do this whether you like it or not. It's not, it wasn't that voluntary at all. It was sort of a euphemism. Makers decided to get smart and do what? Started to build cars here in the US. And so Subarus and Toyotas and Hondas are all pretty much made in the United States now, in order to get away from those quota restrictions and by the way, employ US labor. So in some ways, it's understandable why countries would impose quotas as limitations on, it's usually by numbers or dollar value of certain goods. A more blunt instrument is tariffs. And why it's a blunt instrument is because a lot of times these taxes are simply paid by the buyers, they're simply passed along to the demand side. So even though they're intended to be a supply side tax, as producers are selling these goods, it's oftentimes simply passed along in the form of higher prices to buyers. That goes back to that idea of what's called tax incidence, where it doesn't really matter to the government who pays the tax. It's either the seller or the buyer or both, or one or the other. It doesn't make any difference. And then special restrictions, which are these ideas of special licenses, special paperwork that have to be done, permits, inspections. And I know there are certain countries in the world that are trying to slow down imports into their country by having lots of special inspections and slowing down cargo from doing that. And it's a very controversial practice. And what has been the effort on the part of the trading nations of the world for many decades now is to try to take these barriers down to the extent possible. And there are a number of different international organizations that have been involved in doing this. And among those is the World Trade Organization. And the World Trade Organization, which I'm not going to have time to really get into much, but I'll pick up this. I'll pick this up on Wednesday. This will be my last, where I kick off, and then we'll talk about the exams. The World Trade Organization really tries to promote free trade and tries to encourage countries. It doesn't really have any regulatory authority. It doesn't really have any, there's no real muscle behind it. It tries to exhort countries to try to take down trade barriers so as to promote trade without these sorts of restrictions. So this will be where we pick up. So the questions for me about anything for today. Okay, well, have a great rest of your day. See you all Wednesday.